Welcome back to 5minSmart. Today, we are analyzing a powerful macroeconomic storm brewing across global financial markets. Long-term U.S. Treasury real yields are climbing toward levels not seen since 2008.
That is right, Liam. Investors are demanding higher yields as massive federal deficit spending and persistent bond supply collide with inflationary pressures. The US Treasury market is feeling the strain of prolonged high real borrowing costs.
What role is the Federal Reserve playing in this tightening environment under Chair Kevin Warsh?
The Fed recently held interest rates steady at 3.5 to 3.75%. However, with recent labor data showing a surprise contraction of 23,000 non-farm jobs, while inflation remains sticky, Chair Warsh is facing a delicate balancing act between economic cooling and price stability.
Adding to market volatility is the energy sector and global trade policy. How are oil prices and potential tariffs affecting the macro outlook?
Geopolitical tensions in the Middle East have pushed Brent crude higher, creating supply-side inflation risks. Simultaneously, renewed discussions around global tariffs threaten to fragment supply chains, forcing market participants to price in higher long-term neutral interest rates.
So we have high debt issuance, volatile oil prices, and trade tariff risks all hitting at once. What does this mean for corporate earnings and equity valuations?
Higher real yields raise the discount rate for asset valuations, especially for high-growth tech firms. Companies with high leverage or unproven profitability will face increasing borrowing costs, compressing margins across sectors.
Alice, it is time for our signature segment. What is the smart-sounding sentence for today?
The smart-sounding sentence for today is, the confluence of elevated real yields and persistent fiscal deficit expansion creates a financial tightness that restricts monetary policy flexibility even as economic momentum decelerates.
The confluence of elevated real yields and persistent fiscal deficit expansion creates a financial tightness that restricts monetary policy flexibility, even as economic momentum decelerates. That is an exceptional breakdown of current macro dynamics to share at your next market briefing.
Indeed, it summarizes why rate cuts alone may not immediately lower long-term borrowing costs in a supply-heavy bond market.
As we head into the upcoming Consumer Price Index and Producer Price Index reports, will the Fed be forced to stay on hold, or will yield curve pressures trigger broader market volatility? Let us know your thoughts in the comments. Please hit the subscribe button for daily financial and tech intelligence. If you value our research, consider supporting us via the Ko-fi link in the description.
Stay smart, stay ahead.
I am Liam.
And I am Alice.
We will see you tomorrow.